Hello. We are live now. Actually, to tell you a bit of a backstage, we were already in StreamYard together with Lukas for 10 minutes discussing the current tech ecosystem. But friends, before we start, let me do a quick introduction. My name is Krzysztof Szyszkiewicz. I go by Chris since my name and surnames are unpronounceable. I'm partner at Valueships, and today we have Lukas together with me. Lukas is from Recap. Maybe Lukas, why don't you tell a couple of words about yourself? I'm super excited to talk about what you are doing today.
Sure. Yeah. My last name also for some unpronounceable, especially English-speaking fellows. But nice to meet you guys. I'm here mostly because we financed around, or we underwrote around 1,000+ companies. Actually, having a lot of data on around 4,000 companies of the SaaS sector in the past 3 years. So I've seen a lot of SaaS companies and their funding structures and their funding needs over the last years. That's what brings me here. And me personally, I'm fully sales background. I think I'm a salesperson by heart. I see the most positive in that, and I believe it's usually about finding the right fit. So basically, all of you probably work on finding the product market fit for your products. Once you have it, that's where salespeople should shine and really find the right customers for that. So I've been in fintech for 8 years now. Before that, I've been working in FMCG, and before that in software, security software back then. So a bit of background already. Always quite complex products. That's what I'm looking for. And in financing, even though money can be quite a easy, straightforward product, if you call it that, and lending money, I still think that the individual use cases for each company make it super interesting. So yeah, that's my background. And at Recap, we are currently close to 60 people. I'm leading the commercial part of it. So basically all customer-facing departments are with me, but I'm also working a lot on deals myself. So that's me.
So today we'll talk about money, we'll talk about financing, and we'll talk about tech. So quite of an experience Lukas is bringing to the table. So let's make sure to get the most out of it. Since people are still joining, we have it's already a tradition. I think it's already a 5th or 6th time where we are asking the warm-up question. So the warm-up question is about fortune telling, more or less. So the quick question that we have at the very beginning, maybe at some point we'll actually create a memo out of it or a LinkedIn post out of it about the fortune telling. But what will software look like in 26, but 35? So 10 years from today. So how do you imagine software in 10 years from today?
Good one. I think maybe talking from the Recap perspective, what we do see in the market is that over the past, let's say, 5 years, a lot of companies spread out of the earth like mushrooms. So in each niche, in each industry, we see a lot of companies doing rather the same or on like in the same direction. And in the end, we see consolidation in the market right now, so that there is for each company, once it reaches a certain step, let's say a certain level of revenue, but not really the rocket ship anymore. We do see that in each niche, there's probably going to be a few players that will, in the end, actually make it. I think that's not really news, but I think this will kind of happen to the companies that were funded over the past 5 years, that actually some of them will be merged, will be sold. We see a lot of acquisitions going on. On the other hand, I do think that, we talked about it 10 minutes ago a bit, that a few jobs might actually be replaced over time by software or anything that comes in hand with AI. I think this will most likely also be super innovative companies. I've actually recently met a company that applied for financing with us. They have 4 employees, of which 2 are developers, and they solely develop using AI. And it was crazy what level of deep tech code they've been able to come up with. So I think super interesting to see what's gonna be happening there in the end. Whatever problem you can solve, software is going to be what's going to do that. I think what's probably to me more interesting, how's the software company going to be looking like in 10 years, right? Like how many people are actually needed to run a good, strong software company, and how much of that will be replaced. I think there's a lot to happen, but generally for software, I think it's super strong.
Think
What
so
do you
too,
think?
but then custom software, funny, like good that you are bringing this part, because where I'm coming from, the custom software development companies is the soil of our digital economy, and we see some of them shrinking, especially the ones that were leasing the bodies, doing the staff augmentation type of projects for startups. There were many different reasons behind it: value proposition, cut of financing, etc., etc. Some of them are staying strong, but I think definitely they need to reinvent themselves. Leasing bodies, so to say, leasing developers is not the most sustainable model anymore, in my opinion. Maybe in short term still valid, but in midterm, long term, not really. But funny that not funny, but interesting what you're saying about the consolidation, because it's for SaaS market, I mean, these things already happened somewhere else. So when you think, for example, in e-commerce market, I mean, this is consolidating quite hard right now. I think this happened already in Germany. It happens more and more in Poland. So companies are consolidating. So only the big will survive. It's harder and harder to be small. But then again, from the other perspective, when you think about AI, I mean, what you can do in the group of two people. It wasn't if possible like 3, 4, 5 years ago. Right now, you have two folks sitting at the code, vibe coding, and coming up with amazing software. Lovable can be one of the examples, right? 18 people up until how many millions of ARR? I don't remember anymore, but the benchmarks were crazy. But I guess, Lucas, we could go about fortune telling on and on. We could dedicate one full episode to it. So maybe let's dive into financing. So I would like to understand a bit more what Recap is doing. I mean, I do know, I did my research. We're partners as well. So, but this can be helpful for the audience. And doing a bit of introduction here. I see at conferences, in meetups, etc., you always have this discussion, VC or bootstrap, right? So either we are hardcore bootstrapping, and we are very careful with our money, we focus on profitability, or you have VC, so we are going fast, we are going strong, we are chasing the unicorn. And there is this meme, but there is a third one, right? And I know that maybe it's not necessarily on the same logical level, and nevertheless, the options that you are giving is like the third type of financing companies can get. So if you could tell us a couple of words about how Recap is doing that and what actually you are offering.
Yeah, for sure. I think I would also try to dive out from Recap a bit and rather look at the niche we are in, right? Maybe as one last comment, I don't think necessarily there needs to be consolidation in super big groups, right? But I think everybody needs their niche. And just before I answer the question, just one very brief example. We have a company that we financed. They're called Meisterwerk. So they are in the construction industry, and they also have it's an industry where a lot of SaaS pushes in. So they had to find their niche, which they did. They are like constructors themselves from their past, so they were able to really understand certain issues, which they were able to solve better than others. So I think still there's going to be a lot of niches, right? But you have to make sure that you understand which one is yours, right? So that you don't get eaten up by like other players with more resources and so on. But to get to your question, what we see is basically looking at the whole market. Recap joined a market with the idea of using data to make companies financeable or bankable that are not bankable. So the initial idea was there are certain companies that have assets which are not being understood as assets by like traditional financiers like banks. So a bank would look at maybe a house like real estate, right? So we all know that bank finances real estate, bank also finances businesses once they are profitable and they can show a positive EBITDA for maybe 2 years in a row. That's where you usually start to become bankable. Maybe you are bankable also when you give personal security as a founder, but I think that is the main issue we detected. There's very good companies with strong backing, maybe from investors, maybe the bootstrapping actually might make you bankable, right? Because you will in that case most likely operate cash flow positive or at least neutral. So what we figured is there's quite a few companies which have very good and plannable trajectories, especially in SaaS, because you have customers, they have long-term contracts, they have sometimes software that is very deeply implemented within their own processes. So what we've identified is that you should offer a product to them. And initially we went with a very short-term, very flexible financing approach, which means we try to actually give a lot of the planning of the funding of the cash flow to the company, which actually we ended up figuring out doesn't work. We had to do crazy amounts of education because in SaaS there was, as you said, either bootstrapping or VC. And if you raise like first angel rounds, then maybe VC rounds, what you essentially do looking at your cash is basically you raise a big round, you spend the money, you raise a big round, you spend the money, or you kind of all the time work with the money that you have flowing in. So first thing we detected is that bootstrapping companies are way better at managing their cash flow. They have to be from day one, basically, and they really understood the value of our product. So initially, we had some level of product market fit with bootstrap companies that could basically use Recap to access future cash flows earlier. So the idea was you have an annual subscription, you get it paid monthly. With Recap, you can get the whole year of cash in right now, but you have to pay it back. So initially, the question is, how do I invest it, right? But that was our main issue. Over time, now skipping 1 or 2 years, where's Recap today? We call Recap.
Sorry for simplifying it maybe too much, but if I want to say it in the very simple terms, right? If it's January and my ARR is 2 million, right? In January, basically, I can lend this 2 million to you that I would have received by December 2025. Like I know I simplifying will go deeper to it because I see already your quote on your website get up to 5 million over 5 years. So I would like to understand what stands behind it. But to make it super simple, this is like the logic behind the model.
Exactly. I do have to say that just from the amount you can receive with 2 million, you can probably receive 750,000 euro. So it's between 30 and 50% of your ARR, but then the same logic applies. So you can pre-finance a certain percentage of your future ARR, and you just kind of, in a translated way, pay interest on it, right? So in essence,
And
what
no
we did,
equity.
No equity, yes. In essence, what we did is we said subscriptions are worth something. We are willing to give you money because you have subscriptions and, well, a solid business in general with like good growth and so on. So how did we do that? We did that using data. So we built a platform already 3 years ago, kind of, which at that point already was able to analyze your real-time bank transactions, your subscription data. So if you use Chargebee or Stripe, for example, we can use that data to analyze the business performance and finance you based on that performance. So that's how we assess performance. We don't look at securities per se. We look at performance plus the security of your long-term contracts with the clients. Or sometimes for us, like if you have MRR and the client can theoretically cancel every month, even that we would completely include as soon as we understand how likely the churn is, right? Because we see the past churn, we can anticipate future churn. So that is what basically our first 1.5 years looked like. Then we identified, due to the problem that now we can only kind of serve one target group, which is the already financially educated target group that knows how to manage their cash flow. But we wanted to also get into those who were more used to VC funding and were already VC funded. So there's also a certain sentiment there that they were used to doing this. So we then actually figured out we need to be able to provide very long-term financing and long-term commitment, because that is what you essentially, in the end, also the bootstrapper, what you need is you need a financier where you can understand how they will behave and you have commitment on the funding that you receive. A bit like equity, just that you pay us back in the end, right? Where the equity would actually let you dilute. For us, we give you a certain amount of money. Let's assume you have 5 million ARR, you receive 2.5 million or 2 million from us. You use that money for 2-3 years. So we wanted to make sure that you get away from this very short term. I take this ARR, I pre-finance it. Next month, I take this contract and pre-finance it. So we wanted to take this itty-gritty out. And what we essentially do is we take underlying your whole revenue profile, but we give you a financing that is more like a credit line, kind of. A credit line that we commit over time. So you can build kind of the perfect funding for your use case. The only thing is usually what limits you is the amount, because you have to have the ARR to support the amount. But that is where we are today. And actually, this year we made the step, and with that, I can finish that part. This year we made the step to actually combining software and analysis plus forecasts with this funding product. So basically, you can already get funding for the last 3 years. We are market leader in Germany in the SaaS sector. And you can now also use software to understand your liquidity better, to know when to actually get cash. So we call it the capital operating system. The idea is you attach all your financially relevant information, most important, the bank accounts. We use that data. We understand your past performance, your liquidity, your cash flow, and you can use our insights that we give to you to, in the end, understand your weaknesses of your business, plus also when do I actually need money, and then you can get the money. So that's kind of where we are at right now and what our positioning is right now.
So many aspects. Let me try to go one by one. So at one hand side, there is a financing part. And here I will have a couple of questions, how to get prepared, what is the process. I've heard crazy stories that if I am a founder, you're looking at my data, how I'm spending the money, right? If I'm booking like 5-star hotels or 3-star hotels, gossips, not about recap, but in general, on the side of the business that you are in. And then on the other side, you have a platform, and platform is supporting founders to understand their perspectives financially, but basically to understand that financials a bit better and to be capable of forecasting. So do I read it correctly? More or less, we'll jump into both of them in a minute.
Yeah, I think we are on the correct track.
Cool. So let's start with debt financing. So how the process looks like. We already know that there is it's 30 to 40% of your ARR. But how is the process? When I go to your website, when I go to the websites of different companies who are working with that, I see that you're capable of finishing the round in like 22 days. Basically, this is what you can see, more or less a month. So from what I understand, it is like one of the value proposition is not only money, but you can make it quick. So can you shed some light on how the process looks like, and how to be prepared for such initiative?
Yeah, sure. First of all, initially we marketed 48 hours. Theoretically, that is possible, but we've seen that in the end, nobody has their data in such
under promise over deliver, Lukas.
Yeah,
right?
yeah,
So
we switched
22 days and then 72 hours done.
Exactly, no, but in a perfect world where somebody has a perfectly set up charge B, like not 5 companies within their group and very clear bank accounts and so on, in that world we can theoretically be super quick. But we realized if you actually want to have a very solid funding plan, how we call it, basically us understanding together how we will finance your next 5 years from today's plan. We know plans change, but from today's plan, how should it look? To get to that, I think is a process of roughly 5 working days to get from first contact to a term sheet, and then another 2 weeks for closing. So that brings us roughly to the 20, 22, 30 days. It really depends on how quickly the company provides the information. We have quite a clear process. So what we need, and I think that's how a lot of other financiers in our area also look at it. Most importantly is access to the bank accounts plus a business plan. So we want to understand your past cash flow and past performance based on the bank accounts and your projections based on your business plan. And then we put them over each other and understand if the business plan is realistic based on the past performance. And if it is, and we understand what your plan is, then we move forward and plan the funding moving forward, which we can then put in a term sheet. This process is very smooth and quick. So you can make your commercial decision if you want to go with us. If you do, the actual onboarding and due diligence takes roughly 2 weeks after that, with subscription
legal
data.
due diligence and all this more like set in stone things in the due diligence process, right?
Yeah, we've actually changed our process in a way that we do a red flag screening, is what we call it, before we sign a term sheet, to make sure that we will, with very high likelihood, execute the deal. Because we've seen all the past from the bank accounts, most important information. We see the business plan, which we agree on, and then we do some further checks where we ask a few questions, which happens before we sign the term sheet, so that the actual execution of the term sheet afterwards has a very high likelihood. But there needs to be a kind of technical onboarding that follows, like a classical due diligence, just in a platform, and that takes most time. Usually, it's a bit of itty gritty, but it should ideally not be to understand if the deal works or not. It should ideally be confirmatory of what we've done before.
So the natural question is, what are the typical red flags that you see? What can break the deal?
Yeah, I think this is where we can make a very interesting comparison to other players in the market of what we do. There's very short-term oriented players, which we were also 3 years ago. Today we are not anymore, but we were 3 years ago. Those usually focus on short-term financing, which usually comes with the ability and the willingness to finance companies with very short runway. So let's assume you're VC financed, you have 4-month runway. It would be very hard to be financed by us. You need to show us solid 6-month runway at least, which there's very different reasons. Like if you have investor backing, we will always find solutions, right? We can theoretically finance with less, but we need security. So basically, there we are very cooperative. If you look at the market, you will find players that finance you with less of a solid financial position. It might be a bit more expensive. It's very short term, and you are lacking usually the long-term perspective. Then you have on the very other side of the market, you have companies which are oriented in the super long term. So more that already when you get the money, it's a bit like a classical venture debt, but without the equity pieces. We call it neo venture debt, where you finance very long term. Let's say 2 years of interest only, or 1 or 2 years of interest only, and then 3-4 years of repayment period. But it's less flexible. So the first option is super flexible, but lacking the long term, and then you have the very long term option that's lacking the flexibility a bit. And we position ourselves in the middle because we come from the short term, we move to the long term. So our general idea is you build the funding plan initially for your initial business plan, but if things change and you are healthy, that also can be applied. So going back to red flags, for us, a 6-month runway at least is the hardest red flag. Then we have quite a niche, to be honest, in regards to who we finance today, which is getting bigger and bigger, right? So we finance German and Dutch and UK companies right now. We will move to Spain and Austria short term. But or most likely, this is, you know how roadmap works. Right now, UK is going super well. So there's some pre-launches there, which we are doing. This is how we generally approach it. We try to understand what the sentiment in the market is. So we've launched in Germany and the Netherlands. Now we are currently investigating the UK, and next on the list is Spain and Austria, which in essence means that we have a small market, right? But which is growing quickly, and we can theoretically finance the whole of Europe. So going back to red flags. That means that runway is one, industry could be one. We can't finance, for example, gambling. There's certain classical industries that are hard to finance, right? This would be red flags we would be considering.
And size? What about the size? So what is the minimum size that makes sense to you?
Yeah, so we are currently looking at roughly let's say the actual minimum is 250,000 euro ARR, but that's very small, and that, like in our sense, it rarely makes sense at that size, because you need product market fit and planability in your business to make real use of the money, because you have to show how you can repay it in the end, right? So the better the product market fit, the better is your planability on your actions that you take. So I would say that the average company has at least 500K to 1 million ARR when they start using a product like ours, but you really grow into it between 1 and 5 million ARR. That's where it gets really interesting.
And then the maximum, looking at your website, is around 25 million ARR. Correct me if I'm wrong, but doing a quick math, up to 5 million euros, that gives us roughly 20, maybe a bit below 20 million ARR.
Yeah, I would say that the max really depends on how much money the company needs, right? Because we have a natural limit of 5 million right now, which can grow, right? And usually when we start with a company, we start around max 3 million, but we can grow it later on. But the comfort zone is 0 to 3. And then we can grow it to about 5, but this is a more complicated process, basically. In the end, for us, deals in that size are individual deals anyways. So we just talk to the company, we understand what they want to do. Theoretically, we can also finance bigger than that. We have different options there. So I would never count that out, but our real target group right now is 0 to 3 million in funding. And we have companies that are in the range of 50 to 100 million ARR that are fine with just having a working capital facility in that size, but theoretically they have a way more complex funding structure, right? So it might be that a company in that size finds us very irrelevant if they raise 30 million from a VC. Why would they need like 2 million from us, right? So it really depends on what the company is looking for in their own financing structure.
Yeah, makes plenty of sense. So, sorry for a bold question. I don't want to put you on spot, but why would I choose you instead of VC? So, why would I decide to go for debt financing rather than VC? Because of course, bootstrapping is one thing. We are not talking about bootstrapping right now, but then VC, of course, they take equity, but also, if you are fortunate enough, you score a good VC. I mean, they're providing you also with operational support, right? You have LP who is supporting you. There is a lot of knowledge that is flowing from the VC, the smart money, blah, 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 stuff like this. But I'm sure that debt financing has its own niche and their own rationale. So going back to the question, why would I choose debt financing rather than classical VC pathway?
Yeah, I think to answer that, first you can look at our current portfolio. More than half of the companies we financed are also VC financed. So it's usually not a question, do I do this or do I do that?
So not either or, right? It might be and.
It can be, yes. Like if you are bootstrapping, I think the first question you need to ask yourself is, do I want to have another party on the table? Do I want to have somebody making decisions because they own equity in my company? I think this is a first super relevant question you have to ask yourself. Do I want to go the equity route, especially the VC route? Like angels might be different because they might not have a very clear goal of what they want to achieve. But if you go with a VC, they have a very clear goal and they will push you towards that goal. So I think first you have to understand if you want to go that route at all. If you don't, you have to either completely bootstrap or get some smaller angels in, or use products like ours for which you do need product market fit. So I think usually, let's say, we said it earlier, like 1 million ARR would be a good starting point. There you could start leveraging your growth, investing a bit in marketing or something like that, maybe in sales with using our money. As the better the planability, the more sense it makes to use debt. But the first relevant question, do I want to use equity or do I want to give away shares? And if, to whom? I think that's also a super relevant question. It's not only about the valuation, it's about who am I working with? What type of people are they? Do I feel comfortable working with them? That also goes for the second or third round, where I hear it from so many founders that we work with, that basically it's about the people mostly, right? Also in equity rounds. So that's kind of the first part of this. Once you are equity financed, let's say you went for a seed round and a Series A, and now the question is, do I do maybe an extension to my Series A or do I go with debt? I would say that typically you can see our sweet spot being not the rocket ship. So if you have somebody that is going the super straight path, like seed round, Series A, big Series B, big Series C, and then maybe IPO, that wouldn't be really the company that would use us, because they consume more money than us that then we can provide in relevant size, right? So they kind of they outpace us, I would say, to a degree. They could theoretically reduce the equity like the dilution. If, for example, they raise a 10 million Series A or something, they could maybe use 2 million from us. But like, does it really make sense if everything's in order to make it more complicated and get another party in? Like, I don't think it usually does. So what we are focused at is the company that maybe has raised the Series A, has made some growth, but maybe not hit their plan exactly as they liked. We actually see that's like 80% of the market, right? At least. So those companies that now have options. Do I do a mediocre Series B? Do I do a extension to my Series A at a bad old valuation, maybe, if I can even get my old valuation? Or do I try to grow my top line to increase my valuation for any further fundraisers, or even grow to profitability by using external sources which are non-dilutive like us, right? So drawing a path, we have a lot of companies in the range of 3 to 5 million ARR. So product market fit is clearly there. The company has reached a certain stage. And now the question is, what do I do now? And if you just imagine you can use our money to stretch your runway by 6 months, to grow your top line by 20%, for example, in that time, your valuation will also grow by that. So it's very much significant what you can achieve with this. It's basically usually good when 40% of your ARR is significant money to you. Then I think debt makes sense. And to circle back, I think debt versus equity, it's always the question, do I have to dilute now? Because like equity is always the most expensive, even though you don't pay it back, but you lose shares. So if you can do anything in the same as with the equity and the outcome is plannable, I would always use debt.
So we do have one thing, like most likely have more than one thing in common. But from what you were saying, is that definitely pricing and recap, or value ships and recap, have one thing in common. So we're growing top line, right? And the question that I was always having while working with VCs and Ps, with founders, I was asking myself, hey friends, like, why don't you work on pricing? Why don't you work on discounting before rising a round, right? Typically you have 10 to 15% of your top line leaking through suboptimal discounting, right? So companies that have been with you for quite a while, they for some reason received a discounted price, and after 2-3 years you can easily, typically doesn't influence your churn too much, increase their prices to the baseline, so your top line is rising, and then once you're financing, it shows up in the valuation. So good to see that there is one thing in common. Definitely more than one, but the one that I've spot.
I actually have a question to that, Chris. Like, when looking at pricing, because I totally agree, like pricing, obviously it's all about the combination of customer satisfaction and pricing and potentially resulting churn, right? But if you look at, because you said there might be old clients that are still on very good kind of, from their perspective, pricings, how do you view the initial pricing discussion? How much I'm thinking of how much flexibility do you think it makes sense to give to the salesperson, for example, when negotiating the pricing? How much should you set your pricing? How much should you lure companies kind of in by giving a good pricing initially, then having to increase it later? Like, what's your current view on this?
So that's a very good question. We will spend the next 30 minutes. No, I'm kidding. There is an easy answer to it. Right? Typically 10% is like the maximum for the discount, and this is what works as a rule of thumb. If you don't have 1 day to think about it, to analyze it, 10% most likely will be good enough. But to be very honest with you, typically we structure this by the size of the deal. So if the deal is, let's say, I don't know, your ACV is around 10K, right? So up to 5K, 10% sales can give. From 5 to 10, the sales need to, so the deal from 5 to 10K, the sales, in order to give the discount, needs to get a clarification from, I don't know, another sales or someone senior. From 10 to 50, you need to get in order to get 10% discount or even more, you need to get the acceptance from the manager, and then 50 plus, there needs to be a director, VP, or the board involved in it. We typically call it as a deal desk process. So if you are working with big deals, the decision shouldn't be bound on the one person. So it should be more people discussing it in order to find the sweet spot between conversion and margin. So the easy answer here would have been 10%. And then you need an escalation ladder, so to say. But there should be a process behind it and behind this. And of course, in time, the deal desk or the body in the company who is responsible for margin, for pricing, in time, they should optimize the deal. So either increase the prices in time or decrease the costs in a way that the profit margin stays the same or is equal by the size of the client. So it might be a complex process. It can be also very, very easy process. Again, like another commonality that we both have is that it really depends on the size of the customers that you are working with. So that's typically how the process looks like. So it's not about one-time thing, and this is frequently a trap in pricing that we did it once and then we forget about this. It's much more as a process. We treat marketing, sales as a process, as pricing should be a process as well. But I need to stop here, Lukas, because then I could go on and on and on and on. I'm super talkative. Going back to going back to the topic of the webinar. So I think this is clear to me when it's a good time or what is the use case for debt financing. Like, structuring somewhere in my mind, I would say that if you want to go super fast and you're chasing your dreams, most likely you outpace debt financing. But then if you want to be a bit more agile, have a bit more freedom and go a bit faster than bootstrapping, this somewhere in the middle is the sweet spot for debt financing. And one insight that you gave me, and this is like very important, like interesting for me, it's not either or, right? I mean, you can complement the VC path, which is great. Okay, so we have debt financing, and this is super interesting because on top of debt financing, you build a platform, right, that is supporting the founders in the process. Can you tell us a bit more what the platform is doing and who is the good audience for this platform? We do have plenty of finance technologies products, but I think with your experience, this one can be a bit different. So what we are doing with your platform?
Yeah, I think what's very unique is the way we got to the point we are at now. So our first product, our first monetization based on this analysis that we've always been doing, like, for example, using bank account information to understand company performance, we've used it to understand who to finance and who not to finance, right? Mm-hmm. Based on that information. That's how we got into it, kind of, where we said, okay, in order to grow this to a very like kind of significant player in the market, first what we need to do is build the first financing offering based on that platform and really show that it works, right? We've done that. So we've now built a very significant portfolio in the markets we are active in. And we made the decision based on our analysis that the platform is doing. So it's usually a combination for providing funding. It's a combination of analysis the platform is doing, which is very strict and technical. It's kind of, if you connect your Chargebee and your Stripe and we see exactly your revenue growth, if you connect your bank accounts and we see all your cash flows in the past, we can calculate all the typical SaaS metrics you might know, going through churn, through customer concentration, net dollar retention, growth, the volatility of your growth, of your churn. We calculate all of that and we show it to you. So already 3 years ago when we launched, our clients could see that in the platform, but it wasn't really a software. It was basically, or it was a software, but you didn't pay for it. It was part of your funding, right? So we just had it. And then we also wanted to take the next step, which is actually getting actionable insights based on this, right? So what we do see, if you now look at the liquidity planning space, for example, right, or your liquidity analysis tools out there in the market, they are usually quite complex to set up. So they need very kind of good data integration. They need a lot of work to make work. So what we have kind of optimized over the past is making it plug and play. So right now, we focus mostly on bank accounts when it comes to providing software products based on this. So once you connect your bank accounts to the platform, like 30 seconds later, you see all the analysis, because we use AI. So we got that buzzword in as well.
We are 40 minutes in the webinar, and this is the first time that we mentioned AI. So I think congratulations to us.
Absolutely. So I think so we use AI for bank account tagging, and the system learns how to tag the transactions correctly. So let's assume you connect and you have, I don't know, 98% correctly tagged transactions, but there's maybe a few shareholder loans that are not accurately tagged. You identify them, you tag them, and for future, the system will then tag them correctly if some other occurs. So it has a very high quality from the get-go, and it works plug and play. So what you get is a full analysis of your cash flow. We even built a full P&L based on your cash flow, right? Obviously, it's not like your accounting P&L, but cash flow wise. And you can use it to match your performance. So you can upload your business plan to the platform and match your performance against it. And you can use it for investor reporting, stuff like that. So this is how we've now made the next step. And now we also use accounting data. We've obviously used that to understand company performance as well. And we can also, the platform reads out your accounting data and helps you with certain automation in regards to accounting. So using bank account transactions to kind of kickstart certain accounting processes that most likely on your end currently a human does, but our platform can do. So now we enrich the offering, not only offering the funding, we enrich it by offering software products on top of it, which enable you to understand your cash flow and also understand when to fundraise. The biggest issue, we've been talking about red flags when financing cash burning businesses that are VC financed mostly. The biggest issue is that people start fundraising too late. Also for equity rounds, like it's getting better. Like right now, we see people maybe starting the fundraise, let's say 10 months before the runway goes out, right? But you can't imagine how many good companies I've been talking to that had 4-month runway left, and we couldn't finance them because they had no solution. And if we had talked 3 months earlier, like it would have been the perfect solution, just financing them to the next funding round, for example, or maybe building a plan B to profitability so that they don't have to fundraise. It's super important when you fundraise to never put yourself with the back against the wall. So get your financing in a solid order before you fundraise so that nobody can push you in bad valuations and whatsoever. Bad conditions like liquidation preferences, super important topic. So the valuation is important, but the liquidation preferences are super important as well, so that if you sell your company later at a certain point, that some of the money goes to you and your employees that maybe have stock option programs, rather than only to the investor that has super good liquidation preferences negotiated because you had a weak position at the point of raising the round. So our software initially or essentially helps you to understand when you actually need cash. It helps you stay in a solid state at all points in time, also towards us. Also towards us, you want to, like, we will look at your performance, but you also can use the platform to look at your performance and prepare yourself. Like, ask us for money when you're in a strong position, not when you're in a weak position. So understand when you are in a strong and in a weak position, and we help you with that basically. And a lot of clients say that we replace quite a few big Excel sheets that they've built. So some of that also can be replaced. But that's the software part of the business, and we currently put that kind of together.
Excel is not longer an atlas that is holding your whole finance world. But the side product, correct me if I'm wrong, but when you were describing your product, I've realized that also cash optimization, cost optimization can be the side product of your solution, right? So whenever I receive the same solution in my bank, right, it's B2C use case, completely different. But then, I'm looking at my bank account and I was like, subscriptions. I'm paying like 300 euros monthly on the subscription. Something is terribly wrong here, right? So let's cross them out. So you can be also, devil to your own target market while companies are optimizing their costs while looking at your data. Do you see this use case as well? Or this is much more into financing that you've described?
No, absolutely. I think this is where you can basically look at the different positions and also understand where you pay a lot in comparison to other companies. Like you can compare. We have benchmarking in the platform where you can compare your own performance to the performance of other companies. And if you see that in certain areas you have very high costs, for example, and others don't, you can investigate where that comes from, right? So
Cost versus growth would be interesting, right? So, for example, if you're spending 2x on marketing and you're growing at the same pace, well, maybe there is a room for optimization here, no?
Yeah, absolutely. We also build forecasts based on your data. So we try to understand the development of your different metrics and basically extrapolate them into the future to then to see how from our perspective your performance is going to develop if you follow the plan that you have handed in, right? Obviously, when it comes to forecasting, like if you look in the past, it's 100% truth, right? It's just what you did. If you look into the future, nobody can tell you that, but you can actually use quite clever assumptions based on your recent development, especially in the volatility of your metrics, to understand your future performance. And this is what the platform also offers, and where we try to get stronger, because essentially this is what is very interesting to people. They want to get actionable insights, something they didn't know before. You need to generate that, because you are able to like use the data of currently more than 4,000 companies on the platform with their data, right, that we've onboarded. We can compare all of them, and the software market is not that large, so we can see
You
you and
have
your own.
benchmarks from 4,000 companies. This is what, do I get it correctly?
Yes. So, and not all of them have the bank accounts linked today,
Mhm.
right? Like it's some of them had linked them, and we gathered information on a certain period of time. Obviously, it's anonymized. I think what's important to mention when we talk about data, we are a German company. I'm not sure if that stereotype got through to everybody. We are really kind of strict when it comes to data protection, and all our founders are German, and it's in their bones, in their core, to make.
GDPR compliant. I
Yeah,
was born
exactly.
on it.
Exactly. And we did actually see that some competitors left the market. Actually, quite significant big competitors left the market, especially Germany, because it's such a challenging market regulatory wise. We built something that works, but therefore we are still a bit limited in who we can offer to, because when we launch a country, we want to make it right, you know?
Mhm. But then if the data is anonymized, that should be fine. Me working before with big consulting companies, like benchmarks was also very important to us. So how it typically looks is that, you compare yourself versus the similar industry, similar size. And this is already quite of an benchmark, like quite of a benchmark direction that you can use, right? I'm spending 2x on marketing, or I'm spending too little on marketing. Typical average, the same size of the companies that are like spending on the marketing 50K, I'm spending 20K. Okay, maybe I need debt financing in order to repair this situation, right? So I think that the power of benchmarks in SaaS industry is not that powerful yet, but it will become more and more powerful. We see a couple of companies that are doing great things with benchmarks, with Paddle, for example, or Chart Mogul releasing like amazing benchmarks quarterly. But looking at the other industries, what Accenture is doing with their, for example, CMO reports, right? You can see so much data in there, and I know that big companies are actually using those benchmarks and learning from them. So still in SaaS, I think this will get more and more important. And you, by the way, it seems like you're in a perfect position also to reveal those benchmarks to the world, right? I'm saying, anonymized, high level, more of a top of the funnel exercise, but still quite interesting for the industry. Any like super cool insight that you've learned from those benchmarks? Anything that was super surprising to you?
Well, to me personally, I think not necessarily individual benchmarks, but rather how people planned over the last 3 years. I think it's very clear to see that a lot of business plans are being missed. And I think that is mainly it's clearer with VC financed companies, right? Because they to a degree push you to a certain ambitious mindset. But seeing how normal it is that a plan will not be executed the way it was planned, that did actually surprise me. Not that I didn't expect it, but you have to also be aware that most likely this will happen to your business as well at some point. And I think if you talk about debt, also equity, but we talked about what people do I work with earlier, right? I think when you talk about funding, it's super relevant to know that, or to plan for your negative cases, right? Understand what a negative case looks like. Talk about it with the person you wanna be financed by, and also get a feeling for that, because the likelihood is quite high you will get in that situation at some point, right? And it's not going to go perfect always. So try to have those discussions early, not be too blue-eyed, how we would say in Germany. I'm not sure if that's an English saying as well, but like go into it without really minding too much would be a problem. On individual metrics, I don't think there's anything I would say surprised me crazily. You see everything from to, right? I was very much surprised by a few companies just by their performance, like bootstrap companies that actually managed to hit VC growth levels, which I was super surprised by, but they just had very strong product market fit. So it's very cool to see a company like nearly having the highest growth scores and not being VC financed. Actually, two of our best performing companies are bootstrapped initially, or are still bootstrapped, but we finance them now to accelerate the growth. Because once you've really hit that, like you've been digging and you found the gold, and you need to leverage it, cash might become a problem. And now, how do you solve that? And I think that's where really something like this can be super helpful.
Yeah, you don't need a shovel, you need an excavator or something like that. Right? So at some point, which brings me to my very last question, and then if we have any questions from the audience, please put it in the chat. But this brings me to my last question about the success story. So you said that you are financing right now two companies that are hitting the growth targets of VCs. So what is your personal favorite success story that you've been engaged with while financing, like debt financing?
Yeah, I think I will try to use some where we also did case studies, right? So that I can share the names of the companies. So I think one which was very impressive due to the impact we actually had for them was the company Ride, a German company, also in the software space. They were in the range of 5 to 10 million ARR where we financed them, and they managed to do an exit because we put them in the financial position to actually negotiate a good exit, right? There could have been other paths like keeping the company going to profitability or whatsoever. So I think this was very strong because it was a very well-known German sizable company that actually couldn't have done this without us. That is one very, very interesting stage where also we started the talks early enough. I think that's very important, right? You can get a player like us in if you are early in the process when it comes to funding. So there's never too early. Like if we talk today, we can theoretically seal a funding for in 6 months, but let's not talk in 7 months because then we might have a problem. So that is one interesting part. And the other is actually one of the ones I just mentioned. The company is called Cloud86. They are a Dutch company that is in the web hosting industry. They've been bootstrapping. They are actually also, I think, in the like top 100 fastest growing Dutch SaaS companies, something like that. So they are doing very well for themselves. And in hosting, they have to buy servers. So basically, in order to grow, they have to invest in the servers, and then they can grow on those new servers, right, with the right amount of usage on there. And that pre-investment they've before that been doing with banks, and banks, even if they finance a business because it is profitable, they are very restrictive when it comes to like the next financing, and it's always it's the wrong questions that they ask. I think that's what a lot of founders experience. If you talk to banks, even if they would finance you, they ask the wrong questions. So I think that's also a very good success story, because I think, I don't want to get the numbers wrong, but I think we already quadrupled the amount of bank financing they had for servers in like 1.5 years of working together. And we don't see the end of that, right? Like, it's going super well. They will grow further with us. I think this is two very strong success stories I can tell, but there would be more. I think I didn't mention a bridge to profitability case. Around 60% of our companies that we today finance are bridge to profitability cases where they did raise equity in the past. They are not profitable, but they know how to get there, and they have a cash gap on getting there. Every single one of them is going to be cool because you help the founders without dilution at bad terms to get to a healthy state of cash flow break even. So yeah, you could choose any of those. But yeah, that's
this is an amazing use case, right? When you actually know and you see that you're missing a year in order to achieve the target. You already have the plan. And of course, if you're rising at that time, you are not very well positioned to negotiate. So that must be very tough for founders. And it's great to have solution like, to have another solution, right? So you don't need to dilute anymore. Lukas, so what is, if we have someone who is interested in talking to you or to Recap, how they can reach out to you? Is it like LinkedIn or a website? What is the best way to reach you?
I think I think that is also when you look at how you work together with us. Once we do work together, we are always reachable. I think it's super important to stay close to the client in the end. So you can choose any. You can contact us via LinkedIn, someone from me or one of the investment specialists from my team. You can also go through the website where you can book calls immediately. What I would advise, because it's just interesting and free, just go to the website, connect your bank accounts, and see the analysis. I think even if you don't need funding, like, it's plug and play. If you have 10 bank accounts, it consolidates all of them immediately and gives you a nice overview of the whole company. So that I would generally do, and then you can also figure out where to go from there. But again, you can choose any way you would like, will work.
Cool. So then, thank you very much for today. We're at time. So friends, if you have any either platform needs in order to get your finance right, in order to understand where you're burning too much money and to understand how you compare versus the benchmarks, or if you need money with the capital that won't dilute your dilute your company, dilute your shares, Lukas is a good person to reach out to, and Recap is a good company to reach out to. Thank you very much for today, and we stay in touch. We are partners, content partners, so expect fresh content, I believe, both from Recap and Value Ships. Any closing remarks from your side, Lukas, before we jump in or jump out? Can you jump out? I guess, right?
Jump out
before
of
we
this
say bye-bye.
Yeah, no. Thanks a lot. Thanks for having me. And if you do have any thoughts about funding or liquidity insights and you're interested, just have a quick reach out. Let's have a chat. I'm always interested. Also, if you think your country is not on our list yet, let us know, and we can see if we can make something possible. So thanks a lot, and enjoy your Tuesday.
Thank you very much. Have a good one, and see you soon.
See you. Ciao.